Some people think it's really difficult to value a stock. I'm going to show you how I value a stock using a discounted cash flow model that I built. And I use Intuit QuickBooks for my business in order to keep track of my payroll, my expenses, and all my billing. So let's get started with the model. First, we need the market cap, and it's $74.7 billion. So it's a pretty good sized company. And then we need a stock price, 286.32. And I generally like to invest in larger companies. They're much more safe and secure. I feel it's gambling when you invest in a company that's only a few $100 million. Now we can figure out the shares outstanding because it's just a market cap, 75 billion, divided by the stock price, 286, equals 261 million shares outstanding. The next thing we need for the model is the free cash flow. And free cash flow is the lifeblood of any company. It's the cash that's left over after operating a business minus capital expenditures. And that's how you value a company. And that's exactly what we're doing in this video. I'm going to estimate the future free cash flows and discount that number back to today's value. The next thing we need for the model is the net income. And that's on the income statement. And that's the profit and loss for the company. We also need to get the revenue from the income statement. So we'll pull that and we'll get 4 years of revenue. Put that into. You want to look at the numbers to make sure they're positive. If you have a lot of negatives, like negative free cash flow, negative net income, it's almost impossible to value a company. So you need positive numbers and you need pretty consistent numbers. This looks okay. It's also a good sign that their revenue increases each year. As an investor, that's what I would like to see. Let's get their capital structure so we know what to discount their cash flows by. The interest they pay on their debt is $15 million. And let's see how much debt they have. We go to the balance sheet for that. We go to the liabilities section. And then the current debt is debt due within 12 months. That's $50 million. And then the long-term debt is debt due after 12 months. That's $386 million. So they pay 3.4% interest on the debt. Interest payments are tax deductible, so let's get their effective tax rate. So the income before tax is $1.9 billion. And the income tax is $324 million. So when you deduct the taxes, the cost of debt is 2.9%. Now we need to figure out the cost of equity. So let's get the beta for that. That's the volatility of the stock. The lower the beta, the less volatile the stock is. 1.04. That's a pretty good beta. That means the stock moves with the market. Let's get some more information from the balance sheet. We'll get their current assets. Current assets are mainly cash, accounts receivables, and inventory. And that's $3.6 billion. And then the current liabilities. That's mainly accounts payable and current debt. And that's $1.9 billion. And next we need the equity. That's the value of the company according to the balance sheet. It's total assets minus total liabilities. And then we need the EBIT. That's the earnings before interest and taxes, or operating income. That's $1.9 billion. So that's how much money they generated from the operational business. But that's before they pay interest on the debt and taxes. So now we know the capital structure. It's 10% debt, 90% equity. The cost of debt is 2.9%. The cost of equity is 10.3%. So to get the weighted average cost of capital, it's a blend of cost of equity, 10.3%, and cost of debt, 2.9%. That comes out to 9.5%. And that's the rate we're going to use to discount the future free cash flows. We estimated 4 years of future free cash flows, and then we did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital, and we get a value for the entire company of $49 billion. We divide that number by 261 million shares, and we get an intrinsic stock price of $189. It's trading at $286. So it's trading at a 52% premium. It's a sell according to the model. It's been trading at a premium for a couple of years now. And this happens a lot with a stock where it trades well above their intrinsic value. Since there is a finite number of shares in the market, the more people that want to buy a stock, it drives the price higher and higher. And then the opposite is true. The more people that want to sell a stock, it pushes the price lower and lower. Let's look at Simply Wall Street to see what they value the company at. So they value the company at 202. This is Intuit, Simply Wall Street, and they do a fair value of all the companies. And I like to go to this website just to see if we're in line. Let's go to the financial ratios to get more information on the company. So they have a PE ratio of 48. That's price of stock over earnings per share. That's a really high PE. That indicates it's not a good buy. Next is a price to sales ratio. That's price of stock over sales per share, and they're at 11. The average market is 4, and the median in the market is 2. So their price to book is 20. That's a big price to book. That just indicates they don't have a good book. When I say book, I mean balance sheet, assets and liabilities. The average in the market is 3.6, and the median in the market is 2.2. Price to book value of 20 implies that you're willing to spend $20 to get $1 of book value, which is a bad deal. Next is current ratio, which is current assets over current liabilities. And they have enough in their current assets, $3.6 billion, to cover their current liabilities of $2 billion. So that's good. Really high ROE. Next is interest coverage ratio, and they're fine. They could easily cover their interest payments. Next is debt. They only have 10% debt in that capital structure. Let's compare Intuit's ratios to the trade desk. They're both in the same industry. So Intuit has a better PE, although they're both pretty poor PEs. Both have bad price to sales, bad price to books. They both have okay current ratios. ROE, Intuit's really solid in ROE. Low debt, both of them. I valued the trade desk at a 240% premium, and I'm valuing Intuit at a 52% premium. And it seems like the reason they have such poor ratios because both companies are trading at a significant premium. And the higher the price goes, the worse your ratios appear. So that's something to consider. So thanks for watching the video. Please leave a comment